All right, let's talk about investing. I get it. It can feel super overwhelming, right? Like a high-stakes game with a rulebook written in another language. But what if I told you that the single most important thing you can do for your success has nothing to do with picking the next big stock?
Nope.
It's something way more powerful, and we're going to break it all down right now.
Yeah, this is the big one, isn't it? The number one fear for pretty much everyone starting out. And you know what? It's a totally valid fear. You've worked hard for your money. The idea that it could just disappear in a market crash is absolutely terrifying. But the good news is there's a core strategy, a foundational one, that's designed to tackle this fear head-on. I bet you've heard this a million times, right? But here's the thing. In the world of investing, this isn't just some old, dusty cliche. It is the core principle of a truly powerful strategy. It's the simple, timeless wisdom that keeps one bad egg or one bad investment from ruining the entire breakfast.
And that's the fancy term for it, asset allocation. But all it really means is spreading your investments across different kinds of baskets. The whole goal here is to build a team of investments where not everyone is doing the same thing at the same time. You want some players to zig while others zag. That way, your journey is a much, much smoother ride.
Okay, let's get into the first big idea. Investing's free lunch. Now, in finance, you always hear, there's no such thing as a free lunch. You can't get something for nothing. But asset allocation gets so darn close that many people call it the one big exception. So let's see why.
So what exactly is this free lunch? Well, it's pretty amazing. It's the ability to lower your overall risk, those stomach-churning ups and downs, without having to slash your expected returns. How on earth does that work? It's because different investments react differently to the same news. So when the stock market is having a bad day, something like high-quality bonds might be stable or even go up. That balancing act, that's the magic right there.
All right, section 2, your portfolio's ingredients. So if we're going to build a portfolio, we first need to know what we're working with. Think of it exactly like you're about to cook a meal. First things first, you got to open up the pantry and see what ingredients you have.
So, in the pantry, you've got your three classics. First up, stocks. Think of these as the engine of your portfolio. They give you a piece of a company's success and have the biggest potential for growth, but they can also be a bumpy ride. Then you have bonds. These are your shock absorbers. You're basically loaning money to a company or government, and they provide stability when the stock market gets wild. And finally, cash. That's your safety net. Super low risk, but also very low growth.
But hey, a modern pantry has more than just flour, sugar, and salt, right? We've also got what are called alternative assets. This is stuff like real estate, gold, and yes, even digital assets like crypto. The reason people add these is that they often dance to a completely different beat than stocks and bonds. Now, for most of us, these are like potent spices. Think cayenne pepper. You only need a tiny pinch to add some flavor and diversification, because they definitely come with their own unique risks.
Okay, section 3, finding your personal recipe. And this is so important, because there is no best portfolio. There's only the best portfolio for you. Your personal recipe is going to depend entirely on your life.
So how do you figure out your recipe? You got to ask yourself 3 big questions. First, what are you saving for? I mean, saving for retirement in 30 years is a totally different game than saving for a house in 3 years. Second, when do you need the money? That's your time horizon. The more time you have, the more risk you can usually handle. And third, and this is the tricky one, how much risk can you really stomach?
And listen, here's a really crucial bit of advice. It is so easy to call yourself an aggressive investor when everything is going up. Easy. But your true risk tolerance, that only shows up when the market is crashing and your portfolio is down 20%. That's when your brain starts screaming at you to sell everything. It's human nature. The real test is, can you sleep at night during that storm? That's your real risk tolerance.
Okay, let's make this really concrete. This isn't just theory. Check out these numbers from the dot-com bust back in the early 2000s. An aggressive, mostly stock portfolio got hammered, down over 34%. But now look at the bottom row. A portfolio that was mostly bonds didn't just lose less money. It actually made money. It gained over 6% while the stock market was in a free fall. That is the power of those bond shock absorbers in action.
So what does that look like in practice? Well, it translates into these common portfolio types. You've got aggressive for someone who's got decades to invest and can handle the volatility. Conservative is for someone closer to their goal who's focused on not losing money. And moderate is that popular 60-40 mix right in the middle. Seeing it like this can really help you start to picture where you might fall on that spectrum.
All right, part 4, choosing your chef style. So you've got your personal recipe. Great. Now, how are you going to actually manage it? Are you the kind of chef who likes to constantly taste and adjust? Or do you prefer to put it in the oven, set a timer, and walk away?
Basically, there are 2 main styles. The first is strategic allocation. Think of this as the buy and hold plan. You pick your recipe, say 60-40, and you stick to it, no matter what. You just check in once in a while to make sure it's still on track. Then there's tactical allocation. This is the active plan. This is the chef who's always tweaking the recipe, trying to take advantage of short-term opportunities. It's a lot more work and, frankly, a lot harder to get right.
And of course, there's a middle ground called dynamic allocation. This is where you have your core recipe, but you allow yourself to make small changes based on big, long-term economic trends. So, for example, if it looks like a major economic shift is happening, you might tweak your mix a little bit, but you're not trying to react to every single daily news headline. But what if all that still sounds like, well, a lot of work? Hey, that's totally fine. The great news is there's an even simpler way. You can basically have a professional chef manage the whole thing for you, automatically. Let's talk about that.
These are called target date funds, or TDFs, and honestly, they're the ultimate set it and forget it option. It's so simple. All you do is pick a fund with the year you think you'll retire, like the 2055 fund, and that's it. The fund does everything else. It starts out aggressive when you're young, and automatically, gradually gets safer as you get closer to 2055.
And the way they do this is with something called a glide path. The best way to think about it is like an airplane landing. When your retirement is far off, the plane is flying high and fast. But as it gets closer to the runway, your retirement date, it slowly and smoothly lowers its altitude and speed for a safe landing. A glide path does the exact same thing with your investment risk over the decades. Okay, part 5, the art of rebalancing. Now, if you're not using one of those target date funds, there is one crucial piece of maintenance you absolutely cannot skip. It's called rebalancing, and it's the simple process that keeps your personal recipe from getting all out of whack over time. So let's start here. You've done the work, and you decided on a 60% stock, 40% bond portfolio. This is your target. It's perfectly balanced for your goals and your risk tolerance. All is good.
But then, the stock market has an amazing year. Your stocks grow like crazy. And now, without you even touching anything, your portfolio has drifted. It's no longer 60-40, it's 70-30. And what that means is you are completely by accident taking on way more risk than you originally decided you were comfortable with.
So how do you fix it? You rebalance. It's a simple 4-step process. You look at your portfolio, you sell a little bit of what's done really well, in this case stocks, and you use that money to buy more of what's lagging behind, the bonds. And boom, you're back to your 60-40 target. Now think about what you're doing here. This forces you to do something that's emotionally hard but financially brilliant. You are systematically selling high and buying low. It's built right into the process. But there is one really important catch you need to know about. When you rebalance, you have to think about costs. We're talking transaction fees and especially taxes. If you're doing this in a regular brokerage account, not a retirement account like a 401k, selling those winning stocks can trigger capital gains taxes. So a smarter way to do it can be to use your new contributions. Instead of selling anything, you just put your new money into the part of your portfolio that's underweight until it all evens out again. No selling, no tax bill. Okay, last section. The real key to success. We have covered so much ground here, the ingredients, the recipes, how to be the chef, but I want to leave you with the one idea, the single most important thing that ties all of this together.
What do you think is the biggest driver of your investment returns? A famous study set out to answer that exact question, and the answer is this number, 91.5%. That's right, they found that over 90% of your long-term results come from your asset allocation. It's not from picking the perfect stock, it's not from timing the market, it's from the big picture decision you make about your mix of stocks, bonds, and other assets.
So let's be super clear about this. The game of investing isn't about picking winning stocks. It's about building a winning strategy. It's not about trying to time the market. It's about your time in the market. You're not a treasure hunter looking for a single jackpot. You are an architect carefully designing a plan that's built to last.
So that leaves you with one final question to ask yourself. Which game are you playing? Are you playing the game of speculation, chasing tips and gambling on what might happen tomorrow? Or are you playing the long game of strategy, building a smart, durable plan to get you where you want to go? The choice, really,